Congrats on what seemed like a good quarter, though optically the revenue numbers were lower than the Bloomberg estimates, but very good operational performance, good capacity additions as expected, and good PAT performance. Is there a missing link in the quarter, maybe on the revenue side or maybe something else, or are you happy overall?
Thank you. In fact, the revenue, if you see, is primarily because of in the thermal space. When we see the coal prices as compared to last year, quarter one have moderated one, which is actually a pass-through. And also maybe a part of our thermal generation which moved to job work for our captive customer also resulted in. So revenue is basically any change in the coal prices is a pass-through, so it doesn't have any impact on the results.
Okay, so the fact that both Vijayanagar and Barmer plants saw the lower utilization, planned outage, did that have a bearing too? And of course, please do tell us if you believe that whether most of this would be made up as the year progresses.
Yes, if we talk of Barmer, wherein normally in quarter one, when we go for the major maintenance of the plant, results in a lower PLF. But yes, we are absolutely confident that we will be achieving the desired PLF in the balance part of the year, and our whatever we are the deemed PLF of 80% will be achieved. As we are talking, our PLFs are in the range in the current month of July are in the range in excess of 90% in Barmer plant. So we are confident that we'll be achieving the desired and the targeted numbers of PLF in the balance part of the year. Regarding Vijayanagar, as you asked, Vijayanagar, if we see that there have been issues related to water availability, which resulted in lower operations. But yes, in the early July, the water supplies have normalized. So we expect the PLF in Vijayanagar also going forward will be higher than what we have seen in quarter one.
Got it. So this generation upticks that we've seen, net generation up 18%, renewable energy generation up 44%. You are running slightly ahead of what was anticipated. You reckon that would be the case for the rest of the year as well? Mr. Mahendra, part one is that. And part two on the capacity additions, because again, I think we had a conversation maybe 15, 20 days back when you were citing to this, but it's now been delivered in quarter one. You think that's the run rate that you keep up for the rest of the year as well?
Yes. First, I'll come to in terms of the generation growth, which we have witnessed. If we see the demand growth, after witnessing a healthy demand growth in the country of 7.5% in last fiscal, current year quarter one, the demand growth has been 11%, which is a very healthy power demand growth, which is primarily driven by, we see the growth, higher growth in the manufacturing sector, and also the extreme weather conditions, especially in northern part of the country, which witnessed 22% demand growth in quarter one as compared to last year. As compared to 11% country's growth, demand growth, our generation growth has been 18%, which has been primarily driven by very, very good generation in the hydro energy space, where we have generation has grown by 61%. At country level, if we see, the hydro power generation has remained muted. But on the Sutlej basin in Himachal, where our Karcham and Baspa plants are located, there the generation growth has been 38%, hydro power generation. With our better reliability and maintenance of the equipments and the availability, we have witnessed a growth of 61% generation on Sutlej basin in our plants. Along with that, the new capacity additions of wind which we have commissioned during the quarter, and also the better machine availability of the existing assets in this quarter. These all with some merchant demand growth in the thermal sector. These are the prime factors which have resulted in 18% generation growth for us during this quarter. And going forward, we are confident that the growth momentum in the country is going to remain and will continue, barring, of course, the seasonality, which at times impacts the growth. But overall, the growth looks to be sustainable during the full year. Our capacity addition, if we see that we have added about 291 megawatt of thermal capacity, wind capacity in quarter one. And as I have told earlier also, that in current year, we will be adding close to 3 gigawatt capacity, 2.8 to 3 gigawatt capacity. We are very well on track in the balance quarters, out of which 1.7 gigawatt of wind capacity work, which is in progress, will get commissioned every quarter. And we are sure that this will get added. Over and above that, 240 megawatt of our greenfield hydro plant in Himachal will also get commissioned. We are absolutely certain in the current year. And Unit 2 of Ind Bharat in the current quarter, we are sure will be commissioned. So all these things put together, we are absolutely certain of 10 gigawatt capacity addition during to reach 10 gigawatt capacity by end of current fiscal.
Got it. So 350 megawatt of that 700 megawatt in Bharat also gets commissioned in the rest of the year. Surely, the last time that we spoke, you mentioned that you will advance the targets for of the 2030 target earlier. Would you want to do that at the end of the year, or are you doing it in quarter one itself?
Yes, I think before I just comment on this, I will just like to tell that the total order pipeline, what we have today, which includes the commissioned capacity, the work in progress, which I just told, and the letter of awards which we have received, we are already at 16 gigawatt, which is going to get commissioned in next few years. So so first milestone of 10 gigawatt, which we had said earlier by FY25, we are well on track. And once we deliver and we are close to that number, we will be definitely coming back. And because 20 gigawatt with this order pipeline, we are absolutely certain will happen few years earlier than FY30. So maybe at the right time when we are close to 10 gigawatt, we may be coming out with a strategy 3.0 with a revised numbers for FY30.
Got it. A word on the LOAs that you received, Mr. Mahendra. I think a couple of them that you've announced this morning.
Yes. See, we have received, as I have told earlier also, that now the way the capacity additions in the renewable energy space is happening, the plain vanilla solar or plain vanilla wind is not going to be the real solution. It is a product which needs to be designed, coupled with storage to take care of, one is round-the-clock green power, FDRE, and also they take care of the peak demand, peak hour demand, where we see that during evening peaks, there are many moments when the supply is not in line with the peak demand. So this is the first of its kind bid which came by SECI, which is a combination of solar plus battery energy storage. To take solar will supply power during the daytime, and battery energy storage, battery will get charged during the daytime by solar, and it will take discharge during the evening peaks, and giving a very, very affordable solution to the DISCOMs, to the end consumer. So, and I'm happy to tell this was the first of its kind bid which came of 1200 megawatt of solar, coupled with 1200 megawatt hour of battery storage. We have been able to secure 500 megawatt out of this of solar, coupled with 500 megawatt hour of solar battery energy storage. So I think, as I said earlier, that now we have, we at JSW Energy are just not to be seen as a power generator and a supplier, but a solution provider, a customized solution provider for each and every DISCOM with various options. So on that line, we are confident that more such bids will be coming, and we will be definitely keenly looking toward these opportunities.
Wishing you all the best for that, Mr. Mahendra. Thanks so much for taking the time out and speaking to us.
Thank you. Thank you.
Viewers, thanks for tuning in. It's the most important union budget in many years, and all eyes will be on how the finance minister builds the road to Viksit Bharat.
We are working to make India a Viksit Bharat by 2047.
But
not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline? We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate, investments are robust, more comprehensive GDP.
एक ही लक्ष्य नेशन फर्स्ट, एक ही इरादा 2047 विकसित भारत।
Powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate, investments are robust, more comprehensive GDP.
एक ही लक्ष्य नेशन फर्स्ट, एक ही इरादा 2047 विकसित भारत।
When the whole day passes like a blur, the news just whizzes past, and you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter, the Wall Street deals, finance and policy news that could shape your tomorrow.
Hello and welcome. We are right in the center of earnings now. There's so much happening, and we have one of the top home financiers of the country, Canfin Homes, backed of course by one of the largest public sector banks, and we have with us Mr. Suresh Iyer, who's the managing director and CEO at Canfin Homes, with
morning.
us. Hi, good morning, Mr. Iyer. Just Mr. Iyer, for context, set the context for us. This quarter, growth was slightly on the sluggish side of things, just about 9% odd. And there's also been a margin dip. So talk us through those couple of factors that have played out this quarter and what's in store going ahead.
Sure. First of all, in terms of the disbursement, we must take into the fact that this was a election quarter. So April and month definitely were a little subdued. We had, a lower disbursement in April and May, but June post the elections has definitely picked up well for us. In fact, June month on a standalone basis has been the second best month for us in the last 15 months. In June, we have the only month when we have done better in terms of disbursement has been in March 2024. So I think that is the positive that we take, and July also has opened well. So I am quite confident that the first quarter should not be the indication for the year ahead, and Q2 would be much better. And we stick to our guidance that we had given in the beginning of the year, that we are targeting around 10,500 crore of disbursement for the entire year. The second point, as regards spreads coming down, I would say this is the more normal, because we had given a guidance of 2.5 spread and 3.5 NIM. Last year, if you would recollect, we had a large chunk of portfolio coming out of where the impact of the rate hike was being effected, and the spreads were improving from 2.31 or something in the beginning of the year right up to 2.67. So I guess the 2.55 to 2.6 is a real normal, and that is where we are. We might just see a little bit of an improvement of about 1-2 bips going forward, because we have repriced our short-term CPs, which we had raised at the highest rates last quarter, and those have been repriced this quarter. So about 30 to 40 bips we are benefiting from that. So going forward, we might just see about 1 or 2 bips improvement in our spreads. But this is the new normal, I would say, 2.55 to 2.6%.
Got your point. So that's the new normal in the current macro setup.
Correct.
What happens when the macro changes? Because you have RBI, most central banks, likely going to be hiking rates second half FY25. Now, anybody's guess whether that will actually go through or not. Lots of global macros involved. I understand all of that. What happens if the RBI were to cut rates? What happens to margins, and therefore what happens to your overall numbers?
Unlike the previous years where we were on an annual reset basis, effective Jan, we have changed the policy to a quarterly reset. So as the rates come down, we will also be passing on the benefit to our customers. So I don't think there would be much of an impact in terms of our spreads going forward. We should be able to stick to it, and whatever impact transmission happens from on our borrowing side, we will be able to pass on to our customers as well. And it would not be much of an impact. And quarterly reset is, I think, a little more stabilizes our ALM as well.
Okay, so more certainty around that margin number, even in a changed macro setup. So that's
absolutely.
That is encouraging. Talk to us about what's happening with NPA ratios, because asset quality on a sequential basis has worsened. So talk us through that. Is that just a bottom line problem, in the sense that is that just because advances haven't grown as much as you would have liked this quarter, or what's happening with asset quality?
No, I think it's more of a cyclical thing. Q1 generally is like that for most lenders, because March, the amount of pressure we put and the amount of recoveries that happen, we have to give a little leeway to our customers as well. Q1 last year, we had seen an increase of 31 crores in terms of our NPA, gross NPA, and this quarter, similarly, we have seen about 39 crore increase. Again, it's more of an April effect. But otherwise, I don't see much of a problem in terms of the underlying credit quality, which will have an impact. And going forward, we should see the NPA ratios improving. Year end, we would definitely target for something below 0.8% in terms of our gross NPAs. It will be coupled by two things. One, increase in our portfolio, and two, I don't see much of a further increase going forward in terms of our gross NPA numbers.
All right, breaking news, and you're seeing this at the bottom of your screen, the latest updates from the Economic Survey, and the countdown to Union Budget 2024 begins in earnest, because this is the document that will set the context for the presentation of this very important document by Modi 3.0. This, remember, is going to be the budget that sets the roadmap for growth heading into the next 5 years at the very least. Of course, it's going to talk about growth much further into the future as well. Very importantly, and Pallavi Nahata is joining me on this conversation, very importantly, this document, the Economic Survey, is talking about the growth projections and the outlook for the new financial year. It takes into account several disruptions on the global stage with regard to geopolitics, and it has given a projection of economic growth, GDP growth, of 6.5 to 7%. I'm reading straight from the document where it's saying that considering various factors, the survey conservatively projects a real GDP growth of 6.5 to 7%, with risks evenly balanced, cognizant of the fact that the market expectations are on the higher side. This is an important statement to make, Pallavi, and of course there's a lot more in the economic data and economic survey that we will go through, but the first and the most important point,
right,
a lower than RBI projection for GDP in the current financial year.
That's right. So the RBI does project GDP growth at about 7% or thereabout. And the government instead, the CEA in the economic survey has chosen to give a range that's between 6.5 to 7%. You know, market expectations also remain closer to the RBI's estimate. And there is a fair chance, Alex, that over the next few quarters, especially given the resilience that we have seen in the Indian economy and the fact that GDP growth has almost consistently in recent quarters surprised on the upside, given the range by the government, we will see GDP growth closer to the 7% mark rather than the 6.5% mark. But of course, the economic survey does talk about the number of factors at play and how volatile some of these factors currently are. And as such, it is possibly a mark of caution that the CEA has chosen to give a range for now. It also
and those are the words
right,
that it uses. It says it's cautious about its projection.
That's
it's
right.
speaking about what the IMF is projecting on the global stage. The global economy is set to grow at 3.2% in 2024. The average annual global growth rate was 3.7% during the decade ending FY20, that is the financial year ending 20. Now, it's talked about several aspects in the global stage, but on the downside, it's saying that any escalation of geopolitical conflicts in 2024 could in fact lead to supply dislocations and higher commodity prices. This is something that the RBI has pointed to in several occasions when it is chosen caution and pragmatism and said that it is not yet ready to consider easing of monetary policy. It is also saying that this could, in fact, the economic survey is saying that this could influence the RBI's monetary policy stance. The global trade outlook for 2024, according to the survey, remains positive, with merchandise trade expected to pick up after registering a contraction in volumes. It also speaks, Pallavi, about the monsoon and the fact that it is still a little cautious,
right,
despite the projection for a normal monsoon, because ultimately what matters is the spatial distribution.
Right. Yes, we have seen the monsoons remain fairly volatile. June started off on a bit of a weak wicket, but we have seen the monsoons gain momentum in July. And that perhaps explains the caution being exercised on that front as well. While the deficit that we had seen in June has been made up for by excessive rainfall in several parts of the country. In July, we're still to see what August and September look like. But interestingly, it's, especially given the agricultural implications, it's July which is a key determinant of what the output for the year is going to be like, because that's when the Kharif sowing takes place. But Alex, I'd also like to quickly draw attention to, the economic survey addressing the statistical system. Now, the reason this is, of interest to me at least, is because of the fact that we have had multiple controversies in recent years regarding the MSME and, around the GDP, IIP, inflation, but of course, more than other indicators, the GDP or the lack of the census, we're running late on that as well, and that has had implications on the accuracy of government data. So the government has actually taken the bull by the horn, so as to say, and addressed some of those concerns around India's statistical system. It has also outlined steps that are continuously being taken by the government to strengthen the statistical base. So that's definitely something that is something we're going to be watching out for in the coming months. We are expecting a rebasing in the CPI as well. A lot of concerns around
around the GDP, and these are all works in progress. Like the government has said, it is looking into addressing a lot of these concerns and challenges.
Yeah. So it's interesting. That's certainly something to watch for. A more immediate thing that you would want to look at is why the economic survey has been a little cautious with regard to its projection on GDP, where it said 6.5 to 7%. That's a pretty broad range if you think about it. It says that domestic growth drivers have broadly supported economic growth in FY24, that is the previous financial year, despite uncertain global economic performance. It is said that improved balance sheets will help the private sector cater to strong investment demand. But it's saying that there is a note of caution that is warranted here. It says that private capital formation after good growth in the last 3 years may turn slightly more cautious because of fears of cheaper imports from countries that have excess capacity. Madan Sabnavis, Chief Economist at Bank of Baroda, is joining in. Madan, thanks so much for taking the time. And of course, we would have to give you a little time to go through the nitty-gritties of the document, the fine print. But what stood out to me right off the bat is the fact that the economic survey has been a little cautious in its projection for GDP growth in the current financial year. It's provided it in a range of 6.5 to 7% with risks evenly balanced. What do you make of that?
No, I think, Alex, it's a bit too conservative because we at Bank of Baroda are looking at 7.3, 7.4% with possibly an upside. Because I think the major problems which we had last year in terms of lower growth in consumption and investment is something which we think will turn around in the current financial year. So I think what the government is doing out here is taking a very conservative view of taking 6.5 to 7% as the real GDP growth rate. But I think, Alex, what's really important about this particular number, because I think this is just a forecast and things are going to change during the course of the year. This may give us an idea that this particular number is going to go in when we're talking of the budget formulation tomorrow. So tomorrow, when you're looking in terms of the growth in nominal GDP, I think during the interim budget, they spoke of 10.5%. So if we're really talking of 6.5 to 7% real GDP, it looks like that 10.5% may not really change. So I think that is a kind of an implication I would derive from this conservative estimate.
One other aspect to pay attention to, Madan, is that in the past years, and they refer to private capital formation here, and they refer to private capex. We've seen this government spend quite robustly where required and pushing infrastructure, pushing defense. There's quite a lot that is set aside in the budget for these aspects. And so therefore, quite a bit of the growth is also driven by public spending. Would another interpretation be that the government is going to be a little cautious when it comes to spending? Is that something that you can derive?
See, it's definitely something which cannot be ruled out, because if I am saying that the nominal GDP growth is going to remain virtually where it was when the interim budget was presented, it may follow logically that we may not have too much of change in the capex of 11.1 lakh crores, which the government has projected. So I think that will naturally flow from it. And this would also, if I have to actually extrapolate it further, I would say the 1 lakh crores of bounty which you got from the RBI surplus transfers may probably be used more for containing the fiscal deficit and maybe spend a little bit more on revenue expenditure wherever it's required based on the election commitments which are made, rather than focus more on capex, which may also not be feasible given the fact that 4 months of the year would have been passed by the time this budget gets implemented. So we may not have that much of capacity to implement more projects beyond the 11.1 lakh crores.
All right, Mr. Sabnavis, thank you for taking time and joining us. This is Pallavi joining in. On the economy, the economic survey continues to remain fairly optimistic despite the cautious note that the government appears to be striking in terms of the GDP projection. But all in all, the commentary on inflation or on external metrics or the way forward in terms of fiscal consolidation appears to strike an optimistic note. What are you making of the commentary on the economy?
So I think one thing which we also believe is that the economy is going to perform very well in the current financial year. And even though we are talking of a number less than 8.2%, I think it's the base effect which is coming into a picture, which is keeping the number at 7.3, 7.4, which we at Bank of Baroda are saying, or maybe what the RBI is saying, 7.2, or the government 6.5 to 7%. But I think for what you mentioned about what the economic survey talks about the different sectors in the economy, especially when you're talking of things like inflation or you're talking in terms of exports, I think there's reason to believe that there will be more broad-based kind of growth which we will be seeing this year. And hopefully the kind of challenges which we had last year in terms of consumption being affected by higher inflation will probably not be there. And there could be some kind of a pickup in private sector investment. Because I think the moment we see consumption picking up, there's a case of saying that capacity utilization also improves, which will also finally lead to higher investment from the private sector. So far, we have seen private sector investing more in infrastructure-oriented sectors. This needs to become a bit more broad-based. We can take heart from the commentary provided by the economic survey that if things are going to improve in a more generalized manner, then I think even private sector investment could be looking upwards.
All right. Coming back to inflation, the government does say that in order to have a more accurate data set and be able to take adequate supply side interventions to rein in inflation, high frequency price monitoring data for essential food items collected by different departments may be linked in a way that the buildup of prices at each stage from the farm to the final consumer is quantifiable and monitorable. The survey also goes on to say that the ongoing efforts to construct the producer price index for goods and services may be expedited to have a greater grasp of episodes of cost push inflation. Further, given the results of the household consumption expenditure survey for 2022-2023 that were released not too long back, it may be appropriate to expeditiously revise the consumer price index with fresh weights and item baskets. So clearly, these are concerns that economists have been voicing for a while, and the government seems to have taken note and appears to be working on a lot of these new sort of interventions in existing databases and rebasing some of the existing databases.
No, I think this is something which is long overdue because we are dealing with base years of 11, 12, starting from your GDP to WPI, IIP, and the CPI. So there's evidently need for one to actually change the base years because, what really happens is that any index is based on a particular basket of goods which are relevant at a certain point of time. Now, since 2011, 2012, I think things have changed dramatically in the economy. If you look at the overall consumption power, consumption tendencies, as well as the production rates which we have seen, I think there's been a kind of major transformation which has taken place, especially given the fact that I think we are now more in the digital mode, something which was not there in 2011-12. So there's evidently need for one to revisit these particular indices. But I think the major problem here, I think we should not be in a hurry to do it, is about the choice of the base year because of the fact that we've had the pandemic. And since 2020-21, I think there's a lot of disturbances which are being caused. And every time we end up saying because of the pandemic, low base effect, things are looking so much better today, or they're not looking that as well as what they looked in 2018-19. So I think the choice of the base year will be very, very critical. So I think there needs to be a lot of work done on choosing the right base year because I've been hearing that they've been talking of 22-23 being the ideal base. But even here we have seen that the full recovery from the pandemic has not taken place. So if I choose something like 22-23, I may again be giving a different kind of signals to the market. If I choose 2018-19, which to my mind is probably the right kind of base, it may still sound a bit outdated considering we are in 24-25 right now. So I think this is something which has to be done in a very calibrated and cautious manner so that we shouldn't be fighting over saying whether the choice of the base here is appropriate or not. Because practically speaking, it's going to last for another 5-6 years. So we need to make sure that the base selected is the appropriate one for all of them. In fact, I think we should have the same base here for all the parameters which we're talking about, starting from GDP to CPI. And I think the PPI which you mentioned of, I think this is also something which is long overdue because while we do have the WPI which comes close to a producer's price index, but we should remember that it does not include services. It has only manufacturing and farm products. So strengthening it and bringing about a PPI which is based on the WPI will also be very useful as far as the government is concerned in terms of monitoring price movement in the country.
All right. Interesting points that you're making, Madan. We're also joined by D.K. Joshi, Chief Economist at CRISIL. DK, thanks so much for taking the time, and hopefully you've had a cursory glance at a few of the aspects here. I'm curious about what you make about the projection that the chief economic advisor makes in the survey for GDP growth, real GDP growth in the current financial year. It's a range that has been provided of 6.5 to 7%, which is lower than what several private forecasters are making. Perhaps lower than what you're projecting as well for the current financial year, and what the RBI is projecting, which is at 7%. What do you make of that?
Well, I think it's a fairly balanced projection, I would say. I think if you look around, I think there's so many risks globally lurking around. And also, I think the interest rate hikes that were initiated earlier and the rates are still high, their impact will be felt on the economy, particularly on the urban part. And I think the services pent-up demand is also reducing. So some amount of moderation in growth is expected, and our own forecast is 6.8%, which is precisely between midpoint of 6.5 to 7. So I think it's fairly in line with what we expect, and I think we'll get more clarity on this once I think the monsoon season is over and we know how the agriculture performs, because agriculture hasn't done that well last year. So there will be a very strong base effect. I think if monsoons play out well, I think you will see a very strong growth in above normal growth in agriculture, and that I think can create an upside. But I would completely agree with the broad range that has been provided, 6.5 to 7. Even with this, I think India will continue to be the fastest growing large economy, and so I'm in no conflict with this number.
I'm looking at one of the charts that talks about steadily declining deficit ratios, DK, as well. And in that, we're talking about FY24 projected at 5.6% for fiscal deficit, 2.6% for revenue deficit, and the primary deficit at 2%. That fiscal deficit number is going to be watched very closely when the finance minister presents the budget for tomorrow, because based on what we've seen in terms of the revenue collections as well as what was received from the Reserve Bank of India as a surplus, there is an expectation that this could be revised downwards. Are you expecting that as well? And what, in your estimation or your expectation, will be the projection for FY25?
Well, I think they will signal a lower deficit than in the interim budget. Maybe I think at around 5%. Because I think they have got a windfall from the RBI transfer, which was quite generous, more than what was expected earlier. So they will use it for supporting some of the trailing parts of the economy, and a small part of it will also be used to reduce the deficit from what they had assumed or what they had forecast in the interim budget. So it will actually be distributed between both. I think more fiscal consolidation and more support to the economy. I think the focus will be more on the providing support to the economy.
All right, Mr. Joshi, the ECO survey does also talk about key areas of policy focus in the short to medium term. And one of the first sort of highlights here is the government's need to continue to generate productive employment. To create many jobs, there is need to create the conditions for faster growth of productive jobs outside of agriculture, especially in organized manufacturing and services, even while improving productivity in agriculture. So that's one of the key focus areas for policy in the short to medium term, says the ECO survey. It also talks about the skill gap challenge and goes on to talk about the necessity to tap the full potential of the agriculture sector, as well as easing the compliance requirements and financing bottlenecks confronting MSMEs, and of course managing India's green transition. So clearly the ECO survey does sort of appear to lay out what the policy areas for the government might be in the short to medium term, and these appear to be broadly in sync with the requirements of the economy at this stage. What are your thoughts on what the government is highlighting or sort of trying to highlight in the economic survey?
No, these are perfectly aligned to what needs to be done. I think I completely agree with the statement that we need to create more productive employment in the organized part of the economy, and I think for that we'll need to promote manufacturing sector, and particularly the trailing parts of are also labor intensive, like textiles, leather, gems and jewelry. These have, I think, not done that well in the last couple of years. I think so. There is need to promote these segments. The second is, I think, there are sectors where there is a skill mismatch. I think, for instance, your infrastructure is growing at a fast pace, but you require certain skilled people for creating infrastructure, particularly new infrastructure that is being built, and there is a shortage of those people. And then I think you also need to prepare, apart from this, from an employment perspective, is that there is a very swift movement in the AI domain, and I think it's the AI is able to do many of the things which humans can do. So there could be some disturbance in the job market because of that. So I think, how do you prepare people for that? So I think there is need for skilling, reskilling, and also I think the vocational training requirement where there is a need and you don't have enough people. And on the other hand, you have an unemployable army of people who are simple graduates who can't be plugged into the job market. So I think I completely agree with the employment, productive employment aspect, both from the demand, from the point of view of reducing the skill gap, and also from the point of view of reskilling for the new requirements of the economy. And then I think climate issue is, of course, important. I mean, we all know what the one of the reasons why food inflation is so high is because the climate shocks have intensified, whether it is heat waves or it is the changing patterns of monsoons or unseasonal rains. I think all those things require more adaptation measures. So I'm completely in sync with that. And then for the small and medium enterprises, which are obviously more labor intensive, I think they need to be facilitated more with more support from the credit side. I think they also need a more supportive, enabling environment. I think from the point of view of input costs, etc., which I'm talking of electricity charges and so on, which are higher in India than I think and than our competitors. I think if you want the medium and small enterprises to succeed, I think it goes beyond just provision of credit. So I think broadly, I think these are all good points. And finally, I think the reform part, I mean, which is about reducing the choke points or bottlenecks in the economy, which pay off with a lag. I think if you start them today, you will see the benefits after 2-3 years. So there is need to front load. And finally, I think this budget is going to be effective only for 7-8 months, because I think 1/3 of the year is fiscal year is already over. I mean, there's not much to influence in this fiscal year. So you need to front load all the efforts that you announce in the budget.
Fair point. Just a quick point on state government finances, and I'm referring to point number 1.35, gentlemen, in the economic survey. If you would like to look at that, I will read it out. It talks about the fact that state governments have continued to improve their finances in the previous financial year, and the preliminary unaudited estimates of finances for 23 states, and this includes the large ones, the likes of Uttar Pradesh as well as Maharashtra and various others, including Kerala and Madhya Pradesh, published by the Comptroller and Auditor General of India, suggests that the gross fiscal deficit was 8.6% lower than the budgeted figure of 9.1 lakh crore rupees. And that implies that fiscal deficit as a percent of GDP for these states came in at 2.8% as against a budgeted 3.1%, which is lower. So therefore, this leads in not just to a lower glide path for India at the central level, but India at the central level plus states. What do you make of that, Madan?
Yeah, I think what we have seen in the past is that the states tend to be very much disciplined. That's thanks to the FRBM. Since you have the FRBM norms and you're not allowed to exceed a number of 3%, some states, of course, can go up to 3.25, 3.5, based on the kind of equivalent reforms which they bring into the system. So they have always tended to be very conservative in terms of the spending. So I think one downside of it, something I think which we need to look into the data, is that very often, in case the revenues do not increase to the kind of levels which were expected, these states normally tend to cut back on capital expenditure. So, but at the end of the day, in terms of pure fiscal prudence, I think we have probably in the right direction. And states have been playing their part. So now it's left for the center to make sure that it moves towards the 4.5% next year. So that's why we also believe that they will probably be targeting a number closer to 5% for this financial year. But I think the issue of states is something which needs a bit of rethinking because of the fact that if I'm able to bring down the fiscal deficit by cutting down on capital expenditure, even though I have space to go up to say 3.1%, then is it a case of the states underperforming? That is something which will have to be studied in detail because it's not possible for one to say. It will depend from state to state as to what really are the reasons for it. And because there's also been an issue during the course of the year about the transfer of resources from the center to the state, the timing of it. So that could be something, one of the reasons as to why states have not really been spending that much on capital expenditure. I think lots of them tend to fall back. I realize they've done it for 22-23, and I think for 23-24, a number of them have fallen short of it. But that's probably something which can be taken up. But I think the fundamental thing is that if you're the first thing, a goal should be to ensure that you're within this 3% mark, which I think is a very positive development.
Right. Mr. Joshi, coming back to you, the Eco Survey also does say that in the medium term, the Indian economy can grow at a rate of 7% plus on a sustained basis if we build on the structural reforms undertaken over the last decade. This requires a tripartite compact between the union government, state governments, and the private sector. That's according to the Economic Survey. So about 7%. Or over 7%, that's roughly what the Economic Survey expects the potential growth rate to be in the medium term. Is that broadly aligned to your estimates as well? And also, is that an adequately high pace of growth for the Indian economy?
Well, I think there is on the adequately high, I think we would love to have 8% growth on a sustained basis, but you have to see whether you have the ability to grow at that rate without generating inflation and without generating other macroeconomic instability. So our outlook is that till the end of this decade, we will be able to grow at 6.7% per year, which will take India to a 7 trillion economy by 2030-31, and it will raise the per capita income to the upper middle income category by that time. So that is, I think so. Again, we are slightly lower than 7%, but not very different from what the economic survey is saying. But also remember, I think there is a condition attached. I think they are saying that we need to do reforms, etc. Only then we'll be able to sustain that. So we've taken a base case. I think if you accelerate the pace of debottlenecking, if the private investment also picks up, right now I think we are in a very good condition where the lender and the borrower both are in good health. I mean, banks have low NPAs and the corporate sector has low gearing. I mean, so they can they are in a position to borrow, and you also have lender who's in a position to lend, I think. So clearly there are some things which already fit into this story. The rest upside to what we are saying can be created by accelerating the reform. So I think it's broadly in line with what we are, and looks fairly realistic, I mean, at this juncture.
This has been talked about quite a bit in the recent past. Most recently, you had the SEBI chairperson on Friday talk about participation of retail in the equity markets, and in fact the Economic Survey also alludes to it. I'm reading a section of the Economic Survey. It says that while the outlook for India's financial sector appears bright, some areas will require focused attention going forward. The significant increase in retail investors in the stock market calls for careful consideration. This is crucial because the possibility of overconfidence leading to speculation and the expectation of even greater returns, which may not align with the real market conditions, is a serious concern. For a developing economy such as India, the financial sector needs to support the banking sector and fill the gap in capital required for the economy's growth. I'm going to pause there, but it's an interesting statement that is being made ahead of the presentation of the budget. Madan, I'm curious about what you make of this, because we're talking about financialization of assets, we're talking about a huge influx of capital into the equity markets from the retail investor here in India, and a deviation of capital. Banks are struggling with deposit growth, and some projections, the RBI governor also talking about money moving from fixed deposits and from bank deposits into equity and equity instruments. Is that something that can pose a little bit of a challenge going forward?
In fact, Alex, I would say it's a major challenge, because today, if you're looking at the banking system, I think almost all banks are coping with this particular challenge of garnering deposits. Because if you look at overall deposits, I think the rate of growth has definitely slowed down in the last 1 year or so. Funds are going into mutual funds. Funds are going into the equity market directly because the returns are definitely more competitive. And given the fact that the interest rates have actually peaked as far as the banking system is concerned, as a deposit holder, you cannot really expect to get across the board higher interest rates. And today, when you're looking at the stock market, which is doing very well, there is an incentive for one to go and invest on this particular market. So in fact, if you look at an interesting statistic, is that in this current financial year, almost all the IPOs which were listed had listed at a much higher price than their issue price on the day of listing. So there were substantial gains to be made. Now, I think this kind of development is something which is very positive for the capital market, but it's also a case of saying that you have individual investors are rushing to it, saying, okay, the Sensex is 80,000. We have expectations that Indian economy is the fastest growing economy. People are talking of 5 trillion, 7 trillion, $10 trillion. So therefore, 80,000 will become 90,000 maybe in another year's time, if not earlier. So I think this is something which both SEBI as well as the economic survey is warning, saying that if we see such a thing happening, we could see that retail investors who are investing without too much of knowledge of the markets could have a setback, and then that could have a spiral repercussion downwards. And second, from the point of view of the economy as such, I think we look at the contribution of banks towards growth. It's definitely something which is very much direct, because today, if I'm going to invest in the secondary market, it's just a case of my money going to you, and you're paying me, and I'm receiving the shares. There's no actual investment or financing of investment which is taking place. The same money kept in a bank is going for lending purposes, or it's going for investments in government securities, which is using it for financing the budgetary deficit. So I think there is a productive chain which is out there. So I think this is the major concern. As long as the money is going in for a productive activity, you can be sure that, okay, it's going through a bank or it's going through a mutual fund. There is some kind of a contribution to the general economic growth. But if it's going purely from the point of view of speculative investments, there could be an issue, especially if the large number of funds are moving out. Banks are left with fighting to get funds to fund the kind of credit which we're looking at. There will definitely a kind of a challenge for the economy as a whole. I think that's what's being highlighted.
And in fact, it goes on to say, and the statement that it makes is quite stark. It says the financial sector should expand at a pace that is in lockstep with economic growth. In particular, India can ill afford the economy's over-financialization at its current development stage. Pallavi.
Right. Mr. Sabnavis, I do want to ask you about inflation. So among a lot of highlights that the economic survey has on inflation, one of the points it makes is that the medium to long-term inflation outlook will be shaped by the strengthening of price monitoring mechanisms and market intelligence, and beyond that, focused efforts to increase domestic production of essential food items like pulses and edible oils. Over the past year, or actually more than that, we have seen pulses inflation almost consistently remain elevated. In case of edible oils, we did have a phase where we saw a prolonged period of high inflation there. Currently, of course, we're in a phase where we're seeing deflation in edible oils. But going forward as well, are these commodities specifically expected to remain sort of fragile for India, given our high dependence on exports in case of both of these? Or do you think there is any change taking place domestically here?
No, I think there's a major problem in agriculture, and hopefully the economic survey has recognized that we need to have reforms in the agricultural sector. So far, we have been talking of reforms that's more related to industry and services, but not really to agriculture. We need to change the overall structure of agriculture to make it more commercial, to make it more productive. And what you mentioned is absolutely right. In terms of pulses, we seem to be having a perennial problem because if we look at the overall cost of cultivation, the risk which you have of the monsoon being good or not being that good, access to irrigation being very much limited, we have actually seen that farmers would no longer like to grow crops like pulses. It's much better to grow rice and wheat where you have an MSP, and you also have a case of saying that there is a back-end procurement, which is a front-end procurement, which is there as far as the government is concerned. For edible oils, what we've seen is that the production is not to the same level, but since we import around 55 to 60% of our requirements, the prices seem to be guided by what happens in the international market. So if the price is cool, then even our import price comes down, and we've gotten a benefit in the last financial year, this year. But pulses will continue to be an issue for us unless we're able to increase it, but that cannot be done by the government because these are private decisions taken by farmers.
All right. Thank you so much, Mr. Sabnaviz and Mr. Joshi, for taking time out. But that's some of the key takeaways from the economic survey. Alex, of course, one of the bigger takeaways from the survey has been the government pegging GDP growth for the ongoing fiscal at anywhere between 6.5% to 7%, with medium-term growth prospects at about 7% or upwards of that.
Absolutely. And I'd be very keen to find out what the finance minister has to say about that GDP growth for the current financial year when she presents the budget tomorrow. Just a quick reminder to you before we end this program, we will be live through the day, and of course you can find all of the live action on the budget as well as the analysis and the interpretation of the fine print right here on NDTV Profit. So do stay tuned.
Co-powered by Canara Bank. Together we can.
Associate partner, Radico, Spirit of Excellence.
It's the most important union budget in many years. And all eyes will be on how the finance minister builds the road to Viksit Bharat.
We are working to make India a Viksit Bharat by 2047.
But not without a fair share of politics. Will there be a tilt towards populism? How will the finance minister balance between welfare, capex and fiscal discipline? We get you the most comprehensive news and views on budget impact for investments, the taxpayer and the economy. Ride the bullish India wave only on NDTV Profit.
A powerful driver of India's growth. The Indian economy, development of all regions, technologies and innovations. Inflation is moderate, investments are robust. More comprehensive GDP.
एक ही लक्ष्य, नेशन फर्स्ट, एक ही इरादा, 2047 विकसित भारत।
whole day passes like a blur. The news just whizzes past. And you're trying to stay informed. It is our job to bring you news that truly matters. At Profit 360, we cut through the clutter. The Wall Street deals, finance and policy news that could shape your tomorrow. The newsmakers, the trendsetters, and the innovators. In 30 minutes, we've got you covered. So stay ahead, stay informed, and stay profitable with Profit 360.
Headlines you start your day with. What matters worldwide is now in the palm of your hands. Get ready to seize the day and maximize your financial potential. Stay ahead of the curve with all you need to know on NDTV Profit.
This is NDTV, and you're watching NDTV Profit. In association with Samman Capital.
Hello and welcome. You're watching Budget Trade, but just before we go into Budget Trade, a quick check on the markets. Remember, there was a little bit of nervousness in the early hours of trade, not because of what is happening locally alone, but what is happening globally as well. You had Joe Biden step out of the race for the US elections. That led to Asian markets selling off in early trade. Profit taking on D Street and a little bit of jitter ahead of the budget is all put together has led to the markets having a subdued day of trade. We are sub 24,500, but flirting with those levels from the get-go this morning. The breadth of the market's actually not too bad, and the broader markets are doing slightly better than the benchmark. The Nifty Next 50 and the Nifty Mid Cap are both trading in positive territory. The advanced decline ratio is in favor of the bulls, and that is what we should be taking heart from at this stage. Well, historically, if you look at the last 10 budgets, 6 out of the last 10 budgets saw the markets go in positive the day ahead of the budget, and on 4 occasions, the markets went home negative. But let's not forget that the last 1 month, we've seen the Nifty gain over 5% ahead of the budget. Well, in terms of the big movers and shakers, let's quickly take a look at how the various sectors are doing before we go into various stocks that are moving in today's day of trade. You do have fertilizer stocks that are looking good. Stocks like Yes Bank gaining post-earnings. So lots of earnings reaction is what's playing out on D Street. That's how DCS Bank is off the day's high point, but still trading with marginal gains as we see it. Well, the other one that you want to look at in early trade is how fertilizers are doing. Fertilizer subsidies expected to be increased, and that's what's giving the markets of fertilizer stocks a little bit of an impetus in early hours of trade. HAL is also looking good, 4% higher. These are some of the Modi stocks that have been doing quite well in the recent past. HAL is up 4%, REC is up 3%, NTPC, OMCs are doing well on back of lower crude prices. So stocks like BPCL, HPCL, IOC not doing too badly. Auto counters as well, like M&M trading in positive territory. Pharma is doing all right too, and so is cement. On the sell side, you've got a whole bunch of counters that are seeing some pressure. Wipro is leading the losses with a cut of 9%, largely on back of earnings that disappointed the street. Kotak, Reliance reacting to earnings. ITC, despite a very constructive brokerage note, is seeing some profits being taken off the table. Well, it's all eyes on the budget, and we have with us 2 very special guests joining in. To begin with, Rahul Arora, first up, joins in to share his view with us on the markets. Rahul, thank you very much for taking out the time to talk to us. To begin with, there's so much I know happening. Budget is just one of those many events that the markets are currently working with and grappling with. But let's start with that, right? With a weaker than expected mandate for the BJP, there is some sort of nervousness in some parts of the market which do believe that the budget could be a lot more populist than the equity markets would have liked. Do you agree? Do you feel that nervousness is justified at this stage?
Good afternoon, Samina. Thank you for having me on the show. So I think that's a reasonable assumption to make. I think if you look at countrywide, when you look at states like Telangana, Jharkhand, Maharashtra, I think some populist measures have already started on the ground, whether it's with respect to farm loan waivers, increasing PM Kisan, and so on and so forth. But it would not be an unreasonable expectation to expect that the tilt would be more towards populism than capex in this budget. That being said, I don't think they're going to take the foot off the pedal as far as capital expenditure is concerned, because I think if you look at the last 10 years of the current establishment, capex growth in the first 5 years on a CAGR basis was about 15-16%. That dropped down to about 8% for the remaining 5 years, that is FY19 to 24. Obviously, you had 2 years of COVID in that, where not too much capex happened, but still, an 8% CAGR is not something that they would want to go down from. So I don't think they'll necessarily take the foot off the pedal, but yeah, it would not be unreasonable to expect, some kind of a populist tilt. And by populist, I don't necessarily mean dole-outs. Even for the bottom of the pyramid income levels, the tax exemption that people are talking about, if that's increased by 1 lakh or 2 lakhs, and that puts another 10-15,000 in the hands of people to consume, that's another way of looking at populism. So I think all things considered, I think the headline number that everyone is obsessed with in every budget is the fiscal deficit. And I think that will probably be retained at about 5.1%.